Welcome to a short overview of the tourism financial model template from efinancialmodels.com. The objective of the model is to provide you with a planning tool to determine the financial feasibility of a new tourism project. For instance, this could be a new cable car which takes you to a panoramic viewpoint. This could be a delphinarium to entertain your visitors and guests with a show. Or this can be any other tourism park or attraction where you want to to start a new project. The purpose of this Excel template is to give you a tool to derive the financial projections and derive a financial plan over the next 5 to 10 years and to determine the financial viability of your project. The way this Excel model is structured is you have here three main sheets. One is the executive summary, which contains the summary of the main financials and of the investment results or investment metrics of this project. You have a sheet which goes a bit more in detail for each of the next years to determine a monthly profit and loss budget. And you have a sheet which goes over the next 10 years to determine how your profit and loss statement will look like, your balance sheet, your cash flow statement, and based on that you can calculate for instance, the IRR or the net present value of this project. So let me shortly show you how you can work with this model. So one task to do is to derive the financial projections of your revenues. This said, all your revenues are basically driven by the number of visitors arrivals. So what you need to do is to estimate how many visitors you can attract for the next years, and then also you need to think on, in this case, in which months these visitors will visit you. Tourism projects are mostly subject to a lot of seasonal effects. So there might be months you have no visitors, and there are other months where you have peak season. So this should be reflected in your monthly forecast and budget. Then the next item you have to think about is if you get the visitors, how you can monetize those visitors. And we have here a revenue model framework which has different ways to derive revenues. For instance, you could offer pickup services, you can offer transport, or basically you can offer parking spaces for those which arrive by car. Then if you have, for instance, a transport like a cable car service, you could also charge for a transport fee. If you have a park, there is an entrance fee you can charge. This needs to be a bit more detailed. So in this model, we have prepared a yearly forecast where each year you can basically set different prices for to enter the park. And just to continue this, then there is also restaurants, hotel, which might be part of your project. Might be a small retail shop, and some other premium attractions where you might want to charge extra entrance fees. And all these revenues are dependent on several assumptions. So we have here a suggestion how to model these cash flows. This will go into a monthly budget where you can actually project very clearly which months, how much revenues you target to obtain, and then at the end of the year we'll sum it up to the totals. And basically what will happen is then you have a clear overview in terms of your revenues, from where your revenues will come, and you can basically do a bottom-up forecast for your project. This can be done on a monthly basis, and then of course also aggregated on a yearly basis where you have a clear overview. If you ramp this project up, you get more visitors over the years. Then once it's stabilized, that you have a clear view how many revenues you can obtain and from where these come from. Then the next step is to also forecast the profit. For this, you need to also forecast the cost. There are mostly in tourism, there are a lot of people working as guides or just as in security or as operators of the attractions. So you need to think through how many employees you need and basically forecast this. And in this model, we have the number of full-time employees and also a estimated salary levels per year which need to be spent. In the monthly budget, also this you can allocate on the month. So if you have yearly expenses for your employees, you can then basically go here and say which of your employees can the costs can be allocated per month on a monthly basis. In this case, what we do is we forecast the yearly costs. You have here the number of full-time employees, the salary levels. This gives you the total salary amount per year. And then what we do is we allocate these employee expenses. Some part will go into direct costs, which can be directly attributed to each of your attractions. Some are more overhead, which are sales and marketing, general admin, other operating costs. You can change these assumptions as you like. So depending on where your employee costs will be as per your financial statements. And this goes on. If you go into the budget, on the monthly budget, you see here we start, the monthly budget starts with the revenues, then you have employee costs, you have F&B costs for restaurant, hotels, etc., direct costs, then sales and marketing costs, general admin, etc. And the way we project this, we have here an input sheet where you can forecast the yearly costs and then again break it down and attribute it and allocate it to each of these months. So what this will lead to is that you have a forecast of the monthly EBITDA. You have here the first year, that will be this line here. And as you're ramping up the number of visitors, the next year you see EBITDA should already be higher. And the third year, you should normally also further be able to improve the EBITDA. And here also you still see the seasonality effect on a monthly basis, and then the model builds the EBITDA forecast on a yearly aggregated basis. The model also will calculate the metrics, financial metrics of your project. This means what is the NPV, net present value of your future cash flows, which are discounted by the discount rate. Or another way to look at it, it's an investment project. From that point of view, you will calculate the project IRR, and you will also see what's the effect if you even take the levered IRR by using debt financing. The model also calculates the funding required. So, and then your task is to basically allocate and figure out how you can finance that amount. One part should come from debt financing, the rest part will be from equity financing. So that's the financing amount needed, and then the split to equity and debt. And here on the other side you have the sources, and the model has calculations in there to determine these amounts. And the way to do that is by looking at the free cash flow forecasts, free cash flow to firm, and then free cash flow to equity. I'll not go more in that, it's just to explain the idea. For the equity investment, we have here a very basic model included so that you can also see how this reacts with different type or categories of investors. If you have the founders and you have the investors you want to split, and for instance, if you know that the investors will be satisfied with a 15% return, what you can do is you can allocate them a lesser amount of the equity stake. So you can basically engineer your proposition to the required return, and then you can also see how much the founders should make. These are just example figures, just to explain the idea. The other functionalities of this model just one I want to mention is this sensitivity table. You can run sensitivity on the IRR, either levered or unlevered. And then what the model does, it will create these tables, and these tables have been created by just looking at the main value drivers, in this case the number of visitors. So the question is, what happens if your number of visitors is 10% lower here or 10% higher? What's the impact on your project IRR? Or if your pricing level, all the prices will be increased by 10% or decreased by 10%. So you can see how this project IRR reacts to your assumptions. And we have done this here just as an example for about 6 variables, the EBITDA margin, hotel occupancy rate, and then also required capex. And as you can see in this diagram, basically a 10% change in the assumption has the biggest impacts for visitors and price. So this means this model is very sensitive to these assumptions. Therefore, these assumptions need a lot of thinking, a lot of scrutiny to be validated, as they will make a big difference to the financial viability of your project. So that's a bit the the overview how this model works. To be said, this is just a template. This template, of course, needs to be adjusted for your specific business plan. So what we recommend is that you first go over the assumptions in blue. You try to change them, put the assumptions to 0 for those income streams where you don't expect or you don't have the revenues. For instance, some of those you put to 0, and then we recommend that you go through the model and adjust the model as needed until it fits to your own specific business case. So I hope this overview was useful. If yes, please give our video a thumbs up. Don't forget to subscribe to this channel on YouTube and visit our website efinancialmodels.com. A link to the model we include in the description below. Thank you for watching.